I'll bet that most of you know someone who is actively looking to buy a house right now, and for them, mortgage rates are a really hot topic. There was a generation of home buyers from 2010 through 2021 who borrowed at rates between 3 and 5%. Now, the 30-year average mortgage rate is 7.3%, according to bankrate.com. What does that mean in real dollars? Well, the monthly payment, so principal and interest, on a $500,000 mortgage at 4% is $2,387. The monthly payment on a $500,000 mortgage at 7.3% is $3,428. That's a difference of more than $1,000 per month and over $12,000 per year. It's been quite a reset in mortgage rates over the past 3 years, and there seems to be a general reluctance to accept it as the new normal. After all, the Fed has been making some high-profile cuts to its overnight rate, the Fed funds rate. It has cut the Fed funds rate by 100 basis points, or 1%, since mid-September. But over that same period, the 30-year fixed mortgage rate has increased 70 basis points, or 0.7%. So what's the story there? How can this be explained?
Let's go to the charts.
We'll go back to the turn of the century, so about 25 years of data. Here is the Fed funds rate set by our central bankers. Now let's overlay the 30-year mortgage rate. Visually, you can certainly see periods when the rates move in the same direction. Like, for example, from January 2001 to June 2003, mortgage rates declined to 4.9% from 6.8% as the Fed funds rate was cut to 1% from 6.5%. But there are also instances of negative correlation, like, for example, from January 2008 to August 2008, when the mortgage rate increased to 6.5% from 5.5% as the Fed funds rate was cut to 2% from 4.25%. And there are also periods of no correlation when the Fed funds rate is static, but the mortgage rate whips around like we saw from late 2008 through 2015. It's a mixed bag overall. If we zoom back into this year to see what has happened since mid-September when the Fed kicked off its rate-cutting campaign, it's another example of negative correlation in which the average mortgage rate and the Fed funds rate moved in opposite directions. Instead of comparing the average mortgage rate to the rate set by the Fed, let's remove the Fed funds rate and instead compare it to the 10-year Treasury yield over that same period since January 2000. There is a much more consistent correlation here for sure. So if you want to understand mortgage rates, it helps to understand what's driving longer-term Treasury yields. And it's a little complicated, but for the purposes of this video, I can boil it down to a few key drivers and what I specifically believe has led to the increase in Treasury yields since mid-September when the average mortgage rate and the Fed funds rate started diverging. First up, inflation expectations. When investors expect high inflation in the future, they demand higher yields on government bonds like the 10-year Treasury. This is to ensure that the purchasing power of the fixed income they're going to receive over the 10-year period isn't being eroded. So at a minimum, investors want the 10-year Treasury yield to be higher than expected inflation over the next 10 years. Next up, economic growth. When investors expect strong economic growth, then Treasury yields will rise for a couple reasons. One is because it will take higher yields to entice or convince investors to invest in treasuries instead of investing in stocks, which benefit directly from a thriving economy. And second, because strong economic growth accompanied by robust demand for goods and services can lead to higher inflation. And lastly, the US government's credit worthiness. So think about national debt levels and fiscal policy here. If investors start to have any doubts about the US government's ability to make good on its promises, then the yields on treasuries will rise. So think about it this way. Would you lend to Microsoft and PetSmart at the same rate? Of course you wouldn't. You'd want PetSmart to pay a higher rate to compensate you for the risk that it doesn't ultimately end up paying you back. That covers the main drivers of Treasury yields. There is another piece to this, and that is the spread between the Treasury yield and the 30-year mortgage rate. So while yes, these two rates seem to move in line with one another, the mortgage rate is consistently higher than the Treasury yield by a spread. And this spread has its own set of drivers, but simply put, it's generally 2 to 3 percentage points. So to summarize, all the hype and headlines about the Fed cutting interest rates haven't had a follow-through effect on mortgage rates. Look to the longer-term Treasury market to get a better understanding of what's going on with mortgage rates. That's all for now. Happy New Year. We'll see you in January.